Mickey Dickey here. I have another video from Dave Ramsey. And again, I'm not going to go through it with you, but what the question is, and then there's two of them on here. One says, can I invest before getting out of debt? And the second one is, your CPA needs to stick to taxes instead of financial advice. So there's several things that are going on in this video that I want to go over and make sure this makes more sense to you than what I'm getting from them. Now, again, he's only getting part of the information from the client that he's talking to on the phone. So please understand, he might have a different answer if he got more information. But my biggest issue with Dave on a lot of these issues, he doesn't ask the right question. He does make a statement on here that the CPA needs to stop being a financial advisor because he sucks at it. Well, again, he's not a financial advisor. He may or may not actually be a CPA. He might not. He might just be a tax professional or whatever they have in different states. But I mean, one of the questions that he talks about is, is he trying to get them to invest or, what's the CPA trying to do? Well, the CPA's job or the tax professional's job is to try to save taxes for you. So if you don't want to save taxes, then that's your problem. And, maybe it is better to put money in a Roth or maybe not. But what I'm trying to focus on here is, can I invest before getting out of debt? And again, this is, most of you have seen a lot of my other videos. One of my big problems with Dave is he's so big on paying things off immediately and getting things done. And you can put money in later down the road and make it up. He completely misses the fact that there's compounding that we're missing here. Now, in this video, he talks about the fact that the first thing you need to do is take any matching that there is. Now, this particular person is self-employed, so I'm not focusing specifically on this client. But the gal on the video with him, it makes a comment that, it took her 7 years to get out of debt and that they're doing just fine. Okay, well, let's take a look at this doing just fine thing, taking 7 years to get out of debt. I'm real big on my Excel spreadsheets, so bear with me on this. So the first one I have here is if you're investing now. Now, all I'm doing here is saying, okay, you've got an employer. And again, this isn't for this particular client. This is just in general, the part about waiting to invest. Okay. So in general, as he's right, most 401k or 403b or employers have some type of a match. And again, you can play with these numbers all that you want. All I did was put down and say, okay, the employer match is 6. The employee contribution is 6, and then they're going to get a 3% pay increase every year. This is a very simple spreadsheet, starting them off making 40 grand a year. Okay. So in that first year, you're going to put $2,400 of your own money in. They're going to match it. That's 48. And then I took a 10% compounding rate, which is what Ramsey likes. So again, just going off of what Ramsey likes here. So now, typically speaking, what I try to do is get my retirees to retire at 60, or at least have the ability to retire at 60. Doesn't mean you have to, but in this particular case, I'm just focusing on, if you've got somebody making 40 grand at 30 years old, they get a 3% pay increase. They put 6% in, they get a 6% match, they get a 10% annual, return. And again, this is not exact, but it's as close as we can come when we're doing some planning. So realistically, they should have roughly $1.1 million for retirement in their 401k. Now it's going to be a 403b, or a Roth 401. Again, I'm not trying to debate that part of it, whether you use a Roth or whether you use a actual 401k. Although personally, I like having 3 buckets when I set up retirement for my clients. I like to have a tax-free bucket, which is your Roth, a taxable account, which is what he typically has for your 6 months and other savings. And then I have a tax deferred, which is this. I like to use 3. That's just the way I like to do things. So, different there. But so at age 60, this person should have roughly 1.1 million in this type of retirement account with their employer. Okay. Now, what I'm trying to show here is if they wait to age 37 to pay off all of their debt, at age 60, they're only going to have $659,000. They can't retire with that. I don't know that you can retire with 1.1 million, but you definitely can't retire. And it's almost half of what you have at the same age. So when you tell me that you can wait, again, I don't buy that. And again, the part of what they're trying to focus on is that, well, later on, you can put more money in. Again, they're trying to keep, I'll rephrase. It's not that they're trying to keep you poor, but they kind of are. What they're saying is that if you save now, or you pay off debt now and don't put investments away, down the road, you can put 15% in. My point is you shouldn't have to ever put 15% in just to be able to make it. Because that's his baby step 4. And if you're putting in 15%, they're still only going to match 6 at best. Some of them only match 3. But if you get the best deal on the planet, you're still putting more money in than you need to put in, which again, I don't quite understand the thought process here. Why would I want to put in double at 37, when I'm 37 years old to try to catch up. And at 60, you're roughly going to be there, but you're putting in 15% a year to make it there. When all you had to do was start earlier, 7 years earlier, and only put in 6% a year, which means you've got 9% more that you can actually live and enjoy your life. And again, this is a part I really have a problem with Dave because he just focuses on paying debt off so early. And again, I don't like debt. I agree with him. But if you got somebody who's 30 years old, they're on a 15-year mortgage, you don't need to pay it off sooner than that. They're still going to be done at 45 years old. Again, it's just kind of it's interesting to me how focused he is on this. But all I'm saying is run the numbers for yourself. I mean, just look at the spreadsheets. Which do you want to have? Do you want to start now? Which again, doesn't mean you're not going to get out of debt. You are going to get out of debt. The question is when do you want to be able to retire? And to me, and I look at this and go, okay, if all things being equal, and you're getting the same rate of return, this person's putting in 6% a year. That means they get another 9% that they actually can live life, go camping, take vacations, spend some time with their kids. To me, I like the balance part of this. Now, again, can you put more in here? Sure. I mean, maybe it takes you 10 years to get out of debt instead of 7, and then you can start putting more money aside. I mean, again, however you want to do this. But a couple other things that are confusing he states that when you're self-employed, that you're paying money into Social Security and that you have to do it on your own. That's what's supposed to happen. I don't know that it always does happen. So when you have somebody who comes back and tells you that they're not putting money into Social Security, they're not putting money into FICA, or not FICA, into Medicare, maybe they're not doing it right. So, I mean, there's one question. The other question, the statement that he has on here, which again, I don't like the way he states this. He says that you're paying both sides. Now that's an accurate statement and you are paying both sides. But then he goes on to say that, the government's doesn't like, well, he says they'd like small businesses because he likes to tax you guys on both sides of it. Well, here's the thing. If you work for someone and you make $50,000 and you're supposed to pay, let's say $1,000 into Social Security, 500 of it comes from you and 500 of it comes from your employer. That's $1,000. If you're self-employed, you make 50,000, you still have to put the same $1,000 in there. Otherwise the benefit shouldn't be the same. So he's not trying to hit you on both sides of it. I mean, that's not what Uncle Sam's trying to do here. Uncle Sam is just trying to make things equal. It doesn't matter whether you work for somebody or not. If you make $50,000 and you want to get money out of Social Security and Medicare, you need to put the same amount of money in. So yeah, you are paying both sides of it, but you're just doing the same thing when you have an employer. Your employer's paying part of it. So the same amount's going in. If you did it another way, it wouldn't be fair for everybody else. Because again, when you're making $50,000, $1,000 is going in your case. And what he's trying to say is, if you're putting $50,000, if you're making 50,000, you should only have to put 500 in. No, because you're not putting enough into the system to make it work right in the end. So again, I'm not condoning taxes. I'm not saying Uncle Sam's right, wrong, or indifferent, but otherwise it's just not a fair statement. So again, there's several things I got a problem with there. And yes, maybe the CPA is an idiot. I don't know. But again, what was the question asked to the CPA? What's the CPA's job? Dave beats him up, says, hey, stick to taxes. Well, kind of sounds like they were sticking to taxes, Dave. Telling them how to save money on their taxes. A lot of people want to save money on their taxes because they want to make it now. Okay. That's not the CPA's problem. If the CPA is telling them that they're not putting money into Medicare and Social Security, maybe the CPA doesn't know what they're doing on the tax side of it, which would be a bigger question for me than the other part of it. But, she does have some 401k. She's got some other things. So as far as that particular person is concerned, again, I would be more interested in asking more questions of her or her financial plan to see where she's going to be down the road and what she needs to do and whether she needs to put it in. Now, again, I don't want to get into a debate on Roth or non-Roth and all the stuff he talks about because, he is accurate to a large extent, but we also want to talk about, if you're going to do the Roth, look at some of my other videos because I've got some Excel spreadsheets that show you, yes, he's right. Putting money into a Roth, there's no tax on the growth, but you end up making less in the account. So somewhat maybe balances out. I don't. Watch my other videos if you have some questions on Roth IRAs and whether they're what's best for you or whether you should use traditional. Dickie out.